Hello and welcome guys, and welcome to this session of discussion of workbooks of SPM and BVM. And yes, there's fair bit of panic in all of you because the questions which are contained in the workbook are quite lengthy and yes, a little bit more technical than what have been given in the institute study mat. There are a lot of case study based questions. There are a lot of questions which require you to do calculations which are really lengthy. So, a fair bit of a difficulty level in this particular workbook. So first of all, before starting the workbook, let me tell all of you guys, please don't see this workbook as a benchmark. Yes, one question or two questions from this kind of workbook can come in your examination. This level of difficulty can appear in your examination, but it is not so that the entire paper will be made from this particular workbook, because the level of questions which are there in this workbook is quite reasonably high. So don't worry, don't panic. My idea of saying you all this is don't panic. If you're not been able to do the questions of this workbook, don't panic, because it is definitely above the standard. It is definitely more than what have been there as a past trend in the past examination papers or study mat of the institute. It is definitely more than that, but it is not something which is a usual trend, and it is, to my mind, not possible that the entire paper, can be so critical. There has to be a mix of easy and difficult questions. So accordingly, the questions will be mixed, will be difficult and easy both. So this workbook is just to make you prepared for the worst. So that is how you should see this workbook as. Yes, I've solved the entire workbook, and cost audit workbook also I've solved, which will be available to you on the YouTube channel or in your app. That is also solved by me. Again, I'll follow the same approach. What approach I followed in cost and management audit workbook? The approach is very much the same. The approach is that I will be going through the difficult questions, the technical questions, the lengthy questions, and the easy questions which I feel that they are as per the standards of the institute, the study mat, or we have done them in the class. Those I'm quickly going to brush them through. I'm not going to solve them step by step. That you can solve step by step. You can come back to me if you feel that, sir, you said this question was easy, but it's not easy. I'm not able to understand a particular point of it. You can come back to me and ask whatever question you want to ask, because I've solved this entire workbook. But in this particular lecture, to keep it brief, because now exams are also fast approaching, to keep it brief, to keep it concise, I'm going to focus on special questions, good questions, and majority are good questions only. And I'm going to quickly scan through the easier ones, or quickly go through the easier ones which are there in this particular workbook. So let's start the workbook of SPM and BVM. So let's start the workbook, and let's start with the first module. The first module is dedicated to the risk management chapter. Yes, strategic performance management and the risk management chapter, where we have already studied the Benish M score, right? Now, what has institute done in addition to what we have studied in our class? So Benish M score is a model which tells you about the corporate failure, tells you about the sickness, or tells you about the probability that this firm is going to have manipulation in its books of accounts. Manipulation is the right word. Now, what kind of manipulations will be there? Manipulation in terms of financials. There might be something which is a little bit off in your financial statements. There might be something which is risky. There might be something which is really out of the league. That indication is given by Benish M score in your financial statements, primarily used to prevent fraud, primarily used to prevent accounting related misappropriations. That is the objective of Benish M score. Now, the typical way of dealing with the the questions of Z score or Benish M score is just to apply the formula and come to the conclusion. However, this particular question which have been given in the workbook, this asks you to really describe the theoretical portion of it and conclude about the probability of earnings manipulation of TFC. So a specific point has been picked up, the probability of earnings manipulation, and that is required to be described by you. Now, if you look at our Benish M score model, so this is the Benish M score model, whereby there's an equation. There are a lot of variants to it. DSRI is there, then GMI is there, AQI is there, SGI is there, DEPI is there. So all these have got some significance, some relevance, okay? And this is the relevance. Day sales to receivable index is DSRI. Gross margin index is GMI. Asset quality index is AQI. Sales growth index is SGI. Depreciation index is DEPI, okay? Now in this particular question which has been given in the workbook, you just have to read through this column which is giving you the explanation of each and every component of the risk assessment, the manipulation assessment. That's all, that's it. So that was what was required to be done. Yes, this kind of question has never come in the examination where you are required to actually delve into or actually explain the variables, but this is that kind of a question, okay? So a question in which the probability of earnings is to be explained by you. So let's see, the M score for TFC is given as minus 0.53. So calculation is already given to you in the question itself, which is higher than minus 1.78. The TFC M score is higher. And the acceptable probability of earnings manipulation, the estimate probability of earnings manipulation is 9.58%. So the probability of manipulation is already given to you in the question, which is 9.58%. So the analysis is required to be done in this particular question and not actually the computation. The calculation is not required to be done, but analysis is required to be done by you. Second part says, what are the implications of DSRI and DEPI variables? Now again, a specific variable has been put up and you are required to explain it. You are required to tell what are the implications of it. What will be helpful in this particular question? The explanation which is given along with this particular each and every facet of the equation. And this table comes really handy. This table is important. So if DSRI is 1.03, non-manipulator, the manipulator 1.46. This table is quite relevant in that respect. Now your question will be, sir, do we have to mug up all these values? Yeah, the answer is yes if you see workbook question. But guys, this kind of question has never been repeated in the examination, has never come in the examination in past. So what I would suggest is you just read thrice before your examination. You just read 3 times this entire the numbers, and fairly you will be able to remember some of them, and based on your fair remembrance you can answer the question if at all it comes from this particular portion. But this third column of this table is definitely required to be done, and this PDF I am referring to my book. If you have taken my book, then this PDF is there in my book. As it is, the PDF is also there in the Institute study mat. You can refer from the Institute study mat as well. So yes, that's how the question is to be answered. You have to talk about the DSRI and DEPB variables of TFC. So both DSRI, DEPB have a value of greater than 1. DSRI value greater than 1 may indicate that firm is accelerating revenue recognition. A DEPI value greater than 1 indicates that depreciation rate was lower than the previous year. TFC may have used the aggressive estimates for estimating the useful life and the salvage value adopted for calculating the depreciation. That is the answer. So yes, I know digression from what has been done in past, what has been done in the examination, digression from that, but it's fair. If institute wants to really increase the standard of the paper, then of course it is going deep into these formulas and not only dealing with it in a brief manner. It will go deep into these formulas. So that's why this formula is being used. Illustration number 2. Nidhi CMA gathers the following economic reports for India in the recent 2 months. So it gives you certain information. Building permits. So building permits last month was 1.8%, prior month was 0.7%. So building permits have increased during the current year. So unfortunately there's no hint to what kind of industry is this Nidhi in. We have to just envisage it. We just have to guess it, which industry is Nidhi in. So probably Nidhi is into various sectors: building permits, commercial industrial loans, consumer price index, index of industrial production, new orders for consumer goods, real personal income. So Nidhi is basically an analysis person. Analytical role is there with Nidhi, and Nidhi is giving you these indexes which you have to analyze and give your output on. So building permits 0.70 increased to 1.8%. Commercial industrial loans negative 1.6% increased to negative 0.90. So if it's a negative, then reduction means increase. So this has increased. Okay. Again 0.2% prior month. This month 0.1% is the consumer price index. Loans have increased and price index has increased. Index of industrial production, from 0 it has reduced, it has increased to 0.2%. New orders for consumer goods 1.6% to 2.2%. Real personal income has undergone an increase also. Based on these indicators, what should Nidhi conclude about the phase of business cycle? So the entire economy has got some phases, right? What phase of business cycle the economy is in right now using these indexes? Okay. Now, yes, you might be thinking, sir, we have never done this ever in our SPM module or anywhere else. We have not done this analysis ever. Absolutely true. Absolutely, and that is the idea. This workbook is not to just give you a revision of whatever you have done. The workbook is also introducing some new aspects of BVM SPM in front of you, and I've already always told you guys, there has to be some googly questions. Googly questions will definitely be there. Some questions which you will not be able to envisage from which chapter, from which topic these googly questions will be there. You will have those kind of questions. So absolutely fair that certain questions which are absolutely in a googly form can come in the examination, and these are such questions which can come in the examination, but not to the extent of, say, 40% or 50% of a paper, just 10% or 20%, just to disturb your mind, to disturb your mental balance, and just to make you worried. Oh, the paper is very tough. That's the idea of giving these googly questions in your examination. That's it. But 80% of the paper will be as per the normal standard. Okay. Alright, so commercial industrial loans and consumer price index are lagging indicators. Lagging indicators means this, if they are increasing, that it's an indication that it's a bad trend. Okay. Industrial production and real personal income are coincident indicators. These indicators suggest business cycle has been in the contraction phase. So the business cycle has contracted, which means the economical business cycle has contracted over the period of time. Building permits and orders for consumer goods are leading indicators. Increases in both of these in the latest 2 months suggest an economic expansion may be emerging. Taken together, these data indicate that business cycle may be at or just past its trough. So that is the conclusion which has been given, that the indication is that these data indicate that business cycle may be almost there. So business cycle, the business cycle may be just past or just maybe at the trough, which means which may be at the borderline. This is a borderline case where the business cycle is just at the borderline. It's not very favorable, it's not very bad, it's just at the borderline. So that is the conclusion that we draw, and I thoroughly understand it. Quite sympathetically I can say that yes, if this question comes for the first time in the examination, even a well prepared student will not be able to do it. That is a given fact. That's not a exaggeration. That's a given fact. So don't worry if this question comes for the first time in your exam. Let us move on to illustration number 3 now. Some details have been given to you for an automotive component company. The details are related to sales and accounts receivable. Okay, so using sales and account receivable, you can easily find out the receivable turnover ratio, which then we are going to compare with the industry average. Industry average data is given to you, individual companies data is given to you, then we are going to compare the industry average data with the company data, and then we are going to draw the useful conclusions based upon these analysis. Now if we say the solutions, then changes in sales. First of all, a trend since past 3 years data is given to you. A trend is being analyzed, and this trend requires data in a percentage forms, which means increase or decrease in percentage form. So we have done a very simple exercise. Previous year's data is in the numerator, is in the denominator. Current year's data is in the numerator, and then we have calculated a percentage of increase or decrease in the sales and in the receivables for this particular company, so that we can later on analyze it using the industry average benchmarks which are given to us. This is the receivable to revenue ratio, which is computed as per the actual data which is given in the question. This is the actual data. We have just divided this by this, this by this, this by this to compute the turnover ratio for the company. So wherever in SPM, wherever you are given a comparative analysis of past 3 years and you have been given the industry average, you can easily use it to calculate your comparison and draw meaningful conclusions. Conclusions can be drawn using this average data which is given to you, and these conclusions can be easily referred to in your own style. Okay, yes, model answer is in front of you, but your answer can be absolutely yours. You can write in your own words. You can write a different logic for increase and decrease in the turnover ratios. Okay, no need to follow exact pattern which is given over here. That's really okay, because it's an analysis based question. Can be your own style, can be your own very style. Okay, so yes, I have written some while solving the entire book. I've written some points which I'm going to tell you. So I'm just referring to my written notes as well. I made some notes for each of the question. Illustration number 4. Okay, now illustration number 4 is a question where coffee brewers statement of P&L is given to you, concluding the following figures. The revenue is given to you, cost of goods sold is given to you, administrative cost is given to you. Extracts of opening and closing balance of assets and liabilities are given to you. You have to compute very easy variables, gross profit ratio, return on capital employed, very straightforward computations which we do in our class also while calculating the gross profit. So that's the gross profit ratio and that's the return on capital employed. A very straightforward question. Yes, average capital employed is always preferred more than closing or opening capital employed, and ample data is given in the question to calculate the average capital employed also. Therefore, you can use the data which is given in the question. So that is how the question is to be done, and very easy. I'm not dwelling into it point by point because it's a very straightforward and easy calculation. Okay, so got it. All right, illustration number 5. Now this is a good question having very unique kind of concept which is there in this particular question. Let's read this question. Illustration number 5. GXP Limited has 3 divisions. Its desired rate of return is 14%. So 14% is the desired rate of return. The operating assets and income of each division are given to you. Operating assets are given to you of GXP and operating income is given to you of GX and P. These are 3 divisions of one company only. GXB Limited has 8 lakh of additional cash to invest in one of its division. So any one of the division it wants to invest additional 8 lakh rupees, which is fair. The divisional manager have identified investment opportunities that are expected to yield following ROIs. So if you invest this 8 lakh rupees in G, then you will get 16%. If in X, you will get 12%. If in P, you will get 15%. Which one is the highest? Of course, G. So my first reaction to it will be employ the entire 8 lakh in G. That is my first reaction. But let's see what the question asks us to do. Now these are the 6 asks which question has. Calculate the ROIs at the present for each division. So what is the existing ROIs? These are the future ROIs, expected ROIs. Question is requiring you to calculate the current ROIs, which will be calculated using this data. Right? Right. State which division manager is currently providing the highest ROI. So current ROI is to be compared. Based on ROI, identify the division manager who would be the most eager to accept the additional investment funds. So what do you think? Which division manager will be eagerly expecting investment in its business? Based on ROI, identify the division manager who would be least interested to accept the additional funds. The manager who will not be required, who will not be ready to intake your additional funds. State the division that offers best investment opportunity for GXP Limited. Now forget about divisions, forget about specific division. Talk about the company as a whole. So for company as a whole, what will be the best idea? So division idea, the division option may be different from what is beneficial for the entire company. A division may be benefited by one particular decision, but that will be detrimental to the company. So both the things are required to be analyzed. First, division based analysis. Second, company based analysis. Discuss the conflict between requirement 2 and 4 above. So there will be a conflict between 2 and 4. We'll discuss that conflict. Advise how the residual income performance measure could be used to motivate the managers to act in the best interest of the company. So the residual income performance will be used to best to motivate the managers to act in the best interest of the company, and we'll analyze the residual income performance. Alright, so now we'll be first of all calculating the existing ROIs. Forget about the expected ROI, the existing ROI. Very simple. You divide incomes from on the assets, then you get the current ROI. So ROI is 18%, 16.5%, 13.6%, and once again division G wins. It has got the maximum ROI. So division G has got the maximum ROI. Perfect. Second, which division's manager will be eager to have more investment, will be quite interested in getting investment at any cost, who will be more eager to get the investment in its own hands. Which division manager will have more eagerness to take the investment. Now guys, look at P. G is already earning good return. G's expected return is also very good. G's current return is also very good, right? But if you compare, this is 18, 16.5, 13.6. 18, 16.5, 13.6. Okay. So now, these are the existing ROIs of these divisions, and what will be the future ROIs if the new investment is accepted? It's 16, 12 and 15. Now, G will not be interested in getting the additional funds, because additional funds is going to give him 16% ROI, which is going to degrade its existing ROI. The 18% will average out to a lower percentage of ROI, because the new additional investment will give 16% ROI. So G will not be interested in taking this ROI. This is the current ROI, guys. This is the current ROI, right? Now talk about X. Future ROI is 12%, current is 16.5%. Again, X will not be interested in taking additional investment, because that will downgrade its return. Its return will be downgraded. So X will again not be interested in taking additional investment. But yes, P's existing investment is 15%, and the current ROI is 13.6%, but its additional investment is 15%. So P will enhance its ROI if it takes the additional investment. Then investment will be enhanced, the ROI will be enhanced from 13.6% to 15%. So on average out, maybe 14%, 14.5% will be the average ROI. So P will be the most eager to take this investment. G will not be eager, X will not be eager, because their investment, their additional investment will downgrade their ROI. Their current ROI is 18% and their future ROI will be 16%. So they will not be interested in taking the additional investment. That is the analysis which we have done. So division P will be highly interested in getting this additional investment, because its overall investment return will increase due to this investment. The managers of division G and X both would be reluctant to invest in additional funds of 8 lakh, because the return is lower than what is the expected return. So both the managers of G and X will not be interested in taking this additional investment. Okay. Now, who will give the best investment opportunity for GXP as a whole? Who will give the best investment opportunity for these 8 lakhs? Who will give the best returns to the firm GXP based on the ROI? Of course, G. G has got the best expected return, which is 16%. The future return of 8 lakh rupees is most in case of division G. Whether division G wants or not, it's a different thing that division G will not want it. But as company as a whole will see not the benefit of division G, but the company as a whole, right? So company as a whole, the investment will be best for division G. Now, fifth part. What is the fifth part? Discuss the conflict between 1 and 4, and yes, this is the conflict. G will say no, I don't want it, but firm will want to invest in this 8 lakh in G. That is the conflict. Lack of goal congruence. Goal congruence means similarity or unity of goals. Goals should be same at company level as well as division level. There is no congruence of unity of goals in case of division and specific units. Therefore, this is a lack of congruency which is there. So, the divisional manager are forced to choose between best interest of their division or the company. So, there's a conflict, division interest or company interest. That is a conflict. In requirement 2, the decision of manager of division P is in best interest of the division, but in requirement 4, the decision is in best interest of GXP as a whole. Okay. Then sixth part. Advise how residual income performance measure could be used to motivate the managers to act in best interest of the company. Now, what is residual performance management? To avoid sub-optimization, to avoid company G to not take this investment, what we can do is divisional performance can be measured using residual income. Since the residual income division managers don't reject the proposed projects with lower returns than the existing return of the division, hence the interest of the organization as a whole, division is ready to accept the investment projects with return equal to or greater than the predetermined required return of 14%. RI being an absolute measure has the shortcoming that performance of division with different sizes cannot be compared. So the conclusion is that you give this particular project to division G only because that will yield the maximum result for the organization as a whole, but don't club the rate of return of division G with the additional investment return. Don't club both of them. See it as an absolute measure, see it as a different measure, because if you club, then the performance of division G will go down. Don't club it. Use the additional investment return as an additional measurement only. That is the suggestion which we have given. Okay, sir, got it. Yes, quite a illustrative, quite a detailed, answer. But yes, even if the entire question doesn't come in the question, some fair bits of the question can come in the examination. If not the entire question, then some bit can be there in the examination. All right, illustration number 6. Now, guys, this particular question is absolute analysis of the the balance scorecard. So all the important elements which are related to balance scorecard, which is financial perspective, human resource perspective, customer perspective, are given to you. You have to just analyze them. That's it. The balance scorecard we have done in detail in the class. It's there in the institute study mat also, and it's a pure theoretical question. So I need not delve into the nitty-gritties of this particular question. We can just read it once. You read it once. If you face any problem, then you get back to me, because it's an absolute theory question. Nothing to be discussed practically in this particular question, and a straightforward question. Okay, learning and growth perspective is also there. Okay, just read through this question in detail. Yes, the examiner can be layout to give some theoretically analytical question also, but not all the questions can be theoretical analytical. More practical oriented questions will be there. Again, illustration number 7, same thing, guys. It's a pure theory answer, where we are discussing the performance of a company in great detail. Benchmarking is there. It's a pure theoretical answer, and it's a straightforward answer. It's not something which is calculated. These are the theory numbers these are the practical numbers which are given to you, and based on these numbers, there's a complete analysis which has been done for the projections, for the financials of this particular company. So this analysis is to be read by each one of you, and it's a straightforward analysis which is given in this particular question. So these are the questions which we need to analyze. These are all critical evaluation, analyze, and analysis is there, and this is the solution. It is completely a very straightforward theoretical analysis of the entire situation. Nothing to be discussed as such, nothing to be calculated as such. So I am just quickly brushing through it. Let's come on to illustration number 8. Yes, I will specifically be dealing with questions which require you to calculate a particular calculation which you are not able to do. I'll definitely delve into all those questions, and I have many questions where calculation is quite tough, so I'll be helping you out with that. Okay, now illustration number 8, Z score model. Yes, illustration number 8 is Z score model, and yes, again a straightforward question. Z score is 1.6. 1.6 lies in the gray zone, and the analysis of gray zone is very clear that further investigations are required when you are in the gray zone, and analysis of further elements of your financial statements are required to be done. Mostly in the examination, guys, direct answer will not be given to you. Over here, Z score is given to you, but in the examination you will be required to compute the Z score, then give your comments. Over here you are already given the Z score and you are just reading the comments. This will not happen in the examination, to my mind, to the best of my prediction. This will not come this way in the examination. You will be required to compute Z score and then analyze it further. That will be the answer. Okay, now illustration number 9 is referring to the Argentee's A score. Guys, this is not in our syllabus, so we can easily leave this particular score at all. We can leave it safely. There's no way that examiner can give this particular score in the examination, because this is not there in our syllabus at all. So I'm just leaving it. Just cut this question. Don't do this question while going in the examination. All right, let's come on to the next chapter. Next module is the fundamentals of business valuation, one of the most important chapters of your syllabus. And yes, this chapter is going to command good 10-15 marks in your examination. Okay, sir. Illustration number 1, very, very good question. Yes, detailed and very lengthy calculations, but the logics which are given in this question and the duality of computation that is there in this question is really amazing. Dual computation is required to be done in this particular question. Let me explain how. So Easy Shine is a startup company that uses brushless machine to wash cars. Suppose Easy Shine makes initial investment in equipment of 6 lakh rupees. This is the initial investment. This is the cash outflow. This is the initial investment or the cash outflow. Cash outflow is INR 6 lakhs. The equipment is depreciated on a straight line basis over 4 years to 0 book value. Very, very important point to be considered over here. That depreciation is to be given over 4 years with 0 book value, which means the depreciation is 1,50,000 rupees per annum. But look at the next line, you will get confused for sure. The next line says that at the end of 4 years, the equipment will have a salvage value of 15,000 rupees. Now you may feel that these two lines are contradictory, sir. Why? Because at one hand you are saying that zero book value is there, you have to depreciate till your zero book value, and on the other hand you are saying that there is a salvage value. No guys, this is not contradictory. It's an indication that for calculating depreciation, you have to take zero value. But while you are analyzing your cash flows from this machine, which we'll do in this particular question, while analyzing the cash flow, you will have to take salvage value of 15,000 rupees. So yes, this is a point of confusion, but please don't get confused in the examination also. If both the things come together, then please bifurcate both of them. It's clearly said that the depreciation is to be done on a straight line basis with zero book value, which means depreciation is 1,50,000 rupees. 6 lakh divided by 4, that's it. Many students might do this thing that 6 lakh minus 15,000 divided by 4. No, wrong depreciation. Wrong depreciation. Depreciation will be 1,50,000 per annum. Okay. Easy Shine marginal tax rate is 30%. 30% is the tax rate. The company is financed with 50% debt and 50% equity. The debt carries interest of 6% and the cost of equity is 19.8%. So cost of debt is given to you, cost of equity is given to you. Yes, we will take weighted average cost of capital if the question requires us to calculate the discounting factor, which we will be required to calculate. Sales expenses and cash flows are given to you. So these are the sales, cost of goods sold, gross profit, depreciation, marketing, operating income taxes, operating income after tax. We add back depreciation, add back operating after tax, operating cash flow is there. Then we have the salvage value of the machinery. Okay, this is the salvage value of the machinery. And note one thing, the depreciation is 1,50,000 and not 1,40,000. Okay. Tax on salvage value is also given, after tax salvage value, and total after tax cash flow is also given to you. So imagine, even the cash flows are given to you after calculation in the question itself. Imagine such a beautiful scenario. Cash flows are given to you. The cash flow of each of the year is given to you, which according to me should be calculated by you. But the question gives it. Alright, the ask from us is the sales growth is given. It is expected now, very, very important point guys. It is expected that we'll have year-on-year growth of sales of 50%. 50% is the year-on-year growth. Okay, now these are as per the market sentiments. Now there is a duality, calculation duality in the question. These are as per the market sentiments. According to market sentiments, these are the next 4 years prediction. However, the expectation of the management is different. Expectation of management is that we'll have year-on-year sale of growth of 50%. And cost will remain same as per the market predictions. The sales number will change. So this entire calculation will change as per the expectation. So these are as per the market sentiments, the cash flows as per the market sentiments, and we'll now calculate the cash flows as per the expectation of the management. Both are different. Okay, sir, got it. Okay, now you have to calculate the weighted average cost of capital, and based on 50% probability of both market sentiments and easy shine expectation combined, calculate the NPV. So what we have to do is NPV as per the market sentiments plus NPV as per the management's expectation whole divided by 2. Average is to be taken to calculate the net present value of the entire firm. So two duality in calculation is there in this particular question. I've already told you. Let's see. Weighted average cost of capital is very easy. We have been given the cost of equity, debt, weight of equity, cost of debt, weight of debt. We are factoring it by tax rate, so we get the weighted average cost of capital. 12% is the weighted average cost of capital. Now, NPV based on market sentiments. So market sentiments, cash flow is already computed by the question itself. Market sentiments, cash flow is already computed. 6 lakhs in the beginning, then it goes like this. 3,63,008. This is the market sentiment, cash flow as per the market sentiments. We just have to calculate the present value of it, and we have to calculate the present value of cash flow, and we get the NPV. NPV is there. This is the NPV as per the market sentiments. NPV as per the market sentiments. It's already calculated. Now NPV as per the expectations of the management. Okay, all right. Now we have to calculate the NPV for the expectation of the management. The sales growth is 50%, 50%, 50% for each of the year. Cost of goods sold is about the same percentage. The question already is giving. Market expenses are also as per the same increase. So whatever increase is there in the whatever ratio is there over here, same ratio is followed in the market expectation also. So you can find this ratio by dividing 1 lakh by 4 lakh, 1,30,000 by 5,20,000, 2,800 by 676, 263 by 640. Similarly, you can calculate the marketing expenses as a percentage of sales, and you can accordingly use it over here, because it clearly says that the expenses will remain the same. Assume the cost growth rate remains the same as per the market predictions, right? Cost remains the same, cost percentage remains the same, is that sales will differ. So now first we'll calculate the sales, guys. 50% increase is there to 40 lakhs, then another 50%, then another 50%. 50% change is there. Then we'll apply the same cost of goods sold percentage. Depreciation will remain the same, no change. Marketing expenses will be according to the the old percentages only, which is 20%. The prediction, the market sentiment percentage, same percentage will be applied while calculating the marketing expenses also. Okay, so 20% of sales is the marketing expense. That's what we have calculated. Where do we get 20% from? 20% comes from our sentiments, market sentiments. So market expenses divide by 4 lakhs, 20%. 1,04,000 divided by 5,20,000. This is how the percentage is coming. Okay, so we do this calculation, we less the depreciation, marketing expense, operating income, taxes, operating income after tax. We add back depreciation because we want operating cash flows. We get the operating cash flows, we add the salvage value as it is, and we get the total after tax cash flow. So computation as per the market sentiments is done already. This is as per the management's expectations. Again, we put the discounting factor, compute the NPV, and we get the NPV. Now what are we going to get? We are going to add both of them and divide by 2. Average will be taken for NPV as per the market sentiments, as NPV as per the company expectation. So at the first look you will say that, oh my god, what is this? I'm going crazy. What kind of question is this? But when you solve it and you actually delve into it, and when you see what is the probable solution to it, then you say, oh no, it was not that difficult, it was a reasonable one, right? So always in the examination, while attempting the googly question, this is a tip which I want to give to all of you. When you read the entire question and you are scared of it, oh, this is a blunder, start attempting it, and you'll at least reach to some point. Your brain will start working. If you just leave it as it is, then you are at a loss. So start answering the question at least. And this workbook is a testimony of the fact that, whenever a complex question comes to you, at least attempt it, because it might be easy. It might not be as complex as you are thinking it to be. Okay, like this question, it was not as difficult as what you were thinking. Just have to calculate 2 kind of NPVs, one using market sentiments, one using expectation, and then your answer could easily be computed in that respect. Okay, sir, got it. Let's come on to illustration number 2. Again, an interesting and a good question. Now, calculation is straightforward in this question. Calculation is not difficult, but I have to just discuss one point in this particular question with you. Okay, Arpan is researching a relative valuation of 2 companies in the steel industry, Long Products and National Corporation. So 2 companies are being researched by Arpan. He has gathered relevant information on the companies in the following table. The computation is given. Calculate the price per share to EBITDA for both the companies. You have to compute the MPS to EBITDA. It is a straightforward computation, not a difficult one. And then enterprise value to EBITDA for both the companies. 2 calculations that you need to do in both of them. Okay. Now, while calculating now there are 2 net incomes which are given to you. This is very, very important. This difference is critical in this question. Okay. The calculation is easy. I'm not going to delve into the calculation, but I'm going to tell you difference between these 2 things. So guys, 2 things are there. One is net income and other is net income from continued operations. Now the question is which one to take. Okay, now what is net income and what is net income from continued operations? These are the 2 terminologies which are given in the question, which are the point of confusion. Otherwise the question is very straightforward. EV is required to be calculated, EBITDA is required to be calculated, that's it. Now the difference is that income from continued operation would exclude all the extraordinary items, the items which are not going to recur in future, either income or expense. Extraordinary items are required to be excluded. Secondly, discontinued operations. In the current year, if there is any discontinued operations, if any income or expenses are pertaining to discontinued operations, that will be excluded. Discontinued operations. And thirdly, we'll exclude the changes in accounting policy. any effect of changes in accounting policy which has been incurred in the current year and which will not happen in the future. Okay, because policy doesn't change every year. Please note that policy doesn't change every year. So these are the three things which are excluded from income from continued operations. So you can in a way say that this represents your future maintainable profits. This is the real profit which you can expect in future as well. So this is a more authentic, demarcation of your future. Net income contains all the things which will not recur in future as well. So that is the difference between net income from continued operations versus net income, and therefore in this entire question, the answer is always taken net income from continued operations and not net income. So you will ignore the net income and you will take net income from continued operations while calculating the EBITDA. See, EBITDA is there, right? Net income from continued operations are given. Even the market value is computed, the share based market value is computed, EV over EBITDA is calculated, and the entire question is calculated in that manner. Okay, sir, got it. So calculation is easy, so I'm not dwelling into the calculation. I've told you one critical point which is there in this particular question. Okay. Illustration number 3, all right. Illustration number 3 contains one critical point is which is calculation of beta. How is beta calculated? That is the only different point in illustration number 3. How is beta calculated? What's the formula to calculate beta? That's the only different point in this particular question. All right. So the formula for beta is covariance divided by market variance. That's the formula which we use for beta. Question gives you market standard deviation, security standard deviation. Market standard deviation means what is the probability of market going up and down from its usual trend, and security standard deviation means what is the probability of that particular company going up and down from its usual trend. Coefficient of correlation of security with market is 0.8. This is the coefficient correlation. Many students mistake it to beta. This is not beta. This is coefficient of correlation. Return from market portfolio is given to you 8.69%. Risk-free rate of return is given to you. Only beta is missing. You are required to calculate the required rate of return. So how can beta be calculated? Covariance divided by market variance. Market variance and covariance, we need to calculate both of these figures and to get our beta. Coefficient of correlation is covariance divided by standard deviation of market plus standard deviation of security. Covariance is 0.8 multiplied by, okay, so in this formula, just amend this formula. This should be multiplied, not plus. This should be multiplication. Okay, and simply you have to using your covariance, your covariance is coefficient of correlation multiplied by standard deviation of market, standard deviation of security. You will multiply all three to get your covariance. Covariance is calculated in this manner, right? Then market variance is market standard deviation raised to the power 2. So market standard deviation raised to the power 2, which means we've just calculated our market standard deviation, which is this is the covariance, and we have factored it by 2. This means power raised to the power. Okay, so it is 11.2 11.2 this is 3.5 raised to the power 2. This is 3.5 raised to the power 2. Okay, so market standard deviation, which is 3.5 raised to the power 2, is the market variance. Then you apply the formula covariance divided by market variance. That will give you the beta. So just a matter of remembering the formula, that's it. Not going to the depth of the formula. Okay, so got it. Illustration number 4. Yes, a very easy and straightforward question. Simple Gordon's model is required to be applied over here. We have studied Gordon model in great detail in the class also, guys. A very straightforward and easy formula. I don't think you will face any problem in doing this particular question. If you face any problem, then of course I'm always there. Illustration number 5. Again a straightforward formula, very straightforward. Gordon's model. Again, Gordon's model is required to be used over here. Terminal value is required to be computed. Straightforward question. No complication at all in this particular question. No complication at all. Gordon's formula is required to be used. Similarly, illustration 6 also, guys. Illustration number 6 also. Simple formula, simple calculation required to be done. Simply the future residual income divided by KE minus G. That's a simple Gordon's formula that we need to apply in this particular question also, and the answer will be absolutely in front of you. Nothing complicated about it. Yes, easy, simple formula. Yes, now illustration number 7 has got a twist. This is Very normal, guys. Very normal. Please do these calculations. They are quite straightforward. If you face any problem, you can get in touch with me. Now this is something which is it's very easy, but there's a catch in this particular question. Let's see what is the catch. Okay. East Railroad has a book value of INR 230 per share. So this is the book value of the share, not the market value, but the book value. The company's return on equity is 14%. So whatever company will earn on this book value is 14%. Company always earns on book value. Okay, so 14 multiplied by 230 will get us the amount which company is going to earn, right? And the required rate of return is 12%, which means cost of equity. Cost of earning this 14% is 12%. So what is the net return? Net return is 2%. So what are we going to earn? 230 multiplied by 2%. 14% is the required rate of return. 14% is the return on equity, and 12% is the required rate of return. Required rate of return means cost to the equity. Now guys, in most of the question, only one figure is given to us, either the required rate of return or the return on equity. We assume both as common, but in this question, if both are given, then income is different and cost is different. That is the question. So 2% is actually the return on 230 rupees book value. The dividend payout ratio is 60%. Calculate the value of the share and present value of the expected economic profits. So whatever profits are going to be generated, you have to calculate the present value of the profits. Now, in this particular question, we are going to apply the Gordon's formula, right? This is the normal Gordon's formula. Gordon's formula is, now please understand one very important thing. We need to find out the price of the share. Book value's price is already there, 230. Now what we do is, 230 is the book value of the share plus whatever income this particular share is going to generate in future on this book value, we are going to add the present value of that residual income, the future income also. We are going to add it, that's it. So 230 is the value, book value of the asset, plus 230 multiplied by 2% is the income that we are going to generate, divide by KE minus G, growth rate. Now in this particular question, growth rate is not given to us, therefore we have to calculate growth rate. We already know the formula of growth rate, retention ratio multiplied by ROE. Retention ratio multiplied by ROE. That is how growth rate is required to be calculated. So the ROE is, the retention ratio is 1 minus 60%, the ROE is 14%, so the growth rate is 5.6%. You just apply this in the formula and you will get the price of the share, which is INR 302. So when market price is not given in the question, then the way you have to calculate the market price is you book value plus the present value of the residual income. Present value means till eternity. If they are earning the 14% as the return on that particular share, then what will be the value of that particular residual income in eternity? Discounted value, right? So INR 302 is the value of the share and the economic profit is rupees 72. Okay, got it. Very important again, business valuation methods and approaches. In my module, if you see my book, then I've clubbed these two chapters, basics of valuation and valuation approaches. I've clubbed these two chapters, but in your study mat, both of them are separate. So we'll do both of them separately only. Okay. All right. Yes, a very good question. Chroma Plus has a revenue of 7,500 lakhs. The sales growth and net profit margin forecasts are given to you. Sale will grow. This is the current revenue. Sales will grow 25%, 20%, this ratio of sales will go, and terminal growth rate is also given. Terminal means after 5th year, forever, for infinite years, 8% will be the growth rate. And after 6th year, the infinite growth rate is 15%, that is the terminal flow. So sales growth is given to you and net profit margin is also given to you. Now net capital investment is expected to be 60% of the incremental sales. So whatever is the increase in sales, 60% of that will be the net capital investment. Maybe the question will be requiring us to calculate the free cash flows, and therefore it is giving the net capital investment. Maybe let's see what is the question asking us. Then working capital investment is also given to us. Yes sir, now I'm pretty sure that question is requiring us to calculate the free cash flow from equity or free cash flow from the firm. That's why these information are given to us. Expected to be 30% of the incremental sales. Debt financing will be used to fund 40% of the investment in net capital items and working capital. So whatever is the capital investment and whatever is the working capital, 40% of the amount will be funded through debt, which means loan will be taken. Beta is given to you, risk rate of return, risk premium is given to you. Obviously this will help you in calculating the cost of equity using the CAPM model. Number of shares outstanding is 60 crores, required to find out the rate of return, which will be calculating terminal value, value of equity and value per share. So guys, without judging the question at the first instant, you at least start doing the easy parts. This is the easy part. Rate of return is the easy part. Start doing it at least. So always try to attempt the question as much as you can. CAPM model, straightforward calculation. We put it and we compute our answer. Next is to calculate the terminal value. Now, terminal value is required to be calculated, and of course, to calculate the terminal value, we have to calculate the entire bunch of information for the first 5 years, and then we'll calculate the terminal value. So everything is required to be done together. So we make our table, the usual table which we make, right? Sales which are growing by the growth percentage, right? Sales which is growing as per 25%, 25%, 20%, 16%, 12%, 8%. You just are putting in, addition to it, and you're getting the sales number. Very easy, very straightforward. Net profit margin is given to you. Net profit margin is 20%, 19%, 18%. So, using this net profit margin, you are calculating the net profit. Now, fixed capital investment and working capital investment are taken as a percentage of increase in sales. So whatever increase in sales has happened, out of that 60% is fixed capital investment. I'll give you an example. 9375 minus 7500, 1875 multiplied by 60%. Multiplied by 60% is 1125. So whatever is the increase in sales multiplied by 60% is the fixed capital investment. Whatever is the increase in scale multiplied by 30% is the working capital investment. And whatever is the fixed capital investment and working capital investment, total of these two, 40% of that is the debt financing which is required. So both these figures are given to you, and these three figures are required to calculate the free cash flow from equity. Yes, we are going to reduce the FCI, we are going to reduce the working capital investment, we are going to add the debt financing to get our fixed the free cash flow for equity. And while reading the question, our mind should be absolutely clear that yes, these data are going towards calculating the free cash flow from equity. Your mind should go in that direction while reading the question itself. Okay, sir, got it. So now this kind of a calculation is to be done. A free cash flow from equity is required to be calculated, which is nothing but the net profit which has been earned plus the FCI plus the WCI minus the debt, and you will get the FCFE. And the further question is absolutely straightforward. No complexity in the further question. The complexity was only in the first part to calculate the WCI, FCI, and even first part was not that complex. It was just that the data is given in such a manner that you are intimidated. BVM SPM is all about intimidation and countering that intimidation. So don't get intimidated with any question in this world. Okay, sir, got it. Now let's move on to illustration number 2. PS ratio is required to be calculated. All right, straightforward formula application of PS ratio, price to sales ratio, is required to be done, guys. Nothing complicated in this particular question at all. Direct formula is to be put, price over sales, and you get the answer. Profit margin also given to you, market price per share is given to you. Absolutely straightforward answer. I'm not dwelling into this particular answer. And of course, if you have any problems, doubts, of course, I'm always available. Illustration number 3. We need to calculate the enterprise value. Again, guys, enterprise value to EBITDA is required to be calculated using the given information, and the given information is absolutely straightforward. Given information has got no ifs and buts, no complications in it. Absolutely straightforward. Competition is there, and EV is required to be calculated. Enterprise value is required to be calculated. We have already done it, these kind of questions in the class in great detail. Similar question is there. No complication according to me. Yes, I've written pointers where I need to discuss, the complications with you. I've written down pointers over there. All right. Okay, question number 4. Now, this is one question. Question number 4. The calculation is too detailed. The calculation is too detailed because the data which is given is quite detailed. But the ask is very, very, very easy. Net asset value is required to be calculated, NAV. Earnings capitalization method, earnings is required to be calculated, and the exchange ratio of exhibit is required to be calculated. So the calculation is lengthy for sure, but there's no complication in this particular calculation. It's a very straightforward calculation. Yes, NAV is required to be calculated, which is assets minus liabilities is the NAV. Then value of firm, which is using the earnings capitalization method, is required to be calculated. Quite straightforward calculation, guys. So I marked it as easy, straightforward calculation. Illustration number 5 also, easy, straightforward calculation. Sir, you are marking every question as easy, straightforward. No. There are many questions that I'm going to solve in the class. So these are the questions which are actually straightforward, guys. These questions have no complexity in them. That's why I have marked them as easy and straightforward. So question number 6 is also easy and straightforward. Now this is a good question, illustration number 7, and it requires detailed analysis of the question. Alright, so the ask in this particular question is to compute the we have to compute the free cash flow from equity and free cash flow of the firm. Both the things we need to calculate. Alright, let's read the question. Mr. Jain is analyzing the financial statements of Sterling Limited. He has 2027 income statement and balance sheet, as well as the forecasted 2028 income statement. So 2007 statements are actuals, and 2028 are the forecast. 2028 are the forecast and 2027 are the actuals. Balance sheet and cash flow from operations as shown in the following tables. Calculate the forecasted free cash flow. So you have to calculate the forecasted free cash flow to the firm and free cash flow to the equity. Two things are required to be calculated for 2028, which is expected free cash flow from firm and expected free cash flow from equity. The current free cash flow is already given to you in the calculation. So the question is so kind to us. It is already given the free cash flow, current free cash flow, and the future cash flows are required to be calculated by us. Okay, cash flow from operations forecast of Sterling Limited, 2027 cash flows are given to us. Okay, I need to calculate the expected cash flow. So fixed capital investment is equal to the capital expenditure because there is no assets sales, which is equal to the change in net PPE plus depreciation. Now guys, for calculating the free cash flow from equity, we need to start with what? We need to start with the net income, then we have to add FCI to it, then we have to add WCI to it and reduce the bank borrowings, right? This is I've changed the sequence. We have to reduce the FCI to it, we have to reduce the WCI to it, and we have to add the borrowings to it. This is how we calculate the free cash flow to equity, right? Now the ask is to calculate the FCI and the WCI. If you want to calculate the FCI, then we can easily take the difference between opening and closing balances of your property. So the property, which is the balances of the property which is given in the question. So this is 160, right? And this total is 210. So the increase in the capital is 50, right? Capital expenditure has increased by 50. So 50 is the increase in capital. That's how we're going to take it. Okay. And plus, we'll also have the depreciation element. This is the net asset change. Now if you want to compute what is the actual capital expenditure, we have to add depreciation also to it. Depreciation is 50. Where do I get this depreciation of 50? This is given in this particular table. We have to calculate the FCI, fixed capital investment. First we are taking the difference in the net balance of the assets, then we are adding depreciation to it, because depreciation also is a element of the fixed capital investment which has increased. Okay, so we've got the fixed capital investment as 100 lakhs. So FCI is calculated as 100 lakhs. Closing net PPE, opening net PPE. Closing property, plant and equipment, opening property, plant and equipment. We subtract both of them to get the the fixed capital investment. Then we add depreciation to it, 50, 100 lakhs is the total FCI which is there. Now working capital investment is the change in working capital accounts excluding cash and short-term borrowing. Cash and short-term borrowing should not be taken in the computation, but all other accounts are to be taken in the computation. Opening minus closing. Simple. Opening debtors, opening inventory, opening all the elements which are there. Accounts payable is there. Then gross property, plant and equipment, accumulated depreciation. Accounts receivable is there, inventory is there. Opening minus closing is the increase in working capital investment. So this is the increase in working capital investment. Now, given that depreciation is only non-charge, we can calculate FCF from the net income. So the net income is the FCFF formula. We'll just put the FCFF formula, which is net income plus depreciation plus interest into 1 minus tax rate minus fixed capital investment minus working capital investment. That is how we'll compute the free cash flow from firm. Now to calculate the net borrowings, we need net borrowings, difference between new debts issued and the debt repayments. So again, opening and closing, difference between opening and closing is the net borrowings which we have additionally taken. opening and closing, that's it. Okay, so by reducing opening and closing borrowings, we have calculated the additional borrowings which are taken, which are to be added to get the FE, free cash flow from firm, minus interest into 1 minus tax rate plus net borrowings. That is how free cash flow from equity and firm. So the idea is that, you know, your this formula should be absolutely in your mind. These two important formulas should be in your mind, guys. These are the two important formulas which should be absolutely there in your mind, and only then will you be able to answer such questions with ease, with great, you know. So I'll highlight these two formulas for you. Please highlight these two formulas in your book as well. These two formulas are really required to be on your tips. These two formulas are important formulas. Okay, and the calculation of fixed and working capital is quite easy. Opening, closing minus opening, closing minus opening. Okay, sir, got it. Let's move on to illustration number 8. All right, so in this particular question, what is the suppose momentum company has a revenue of 2000 lakhs this year. However, we assume that future performance will be tracked relative to sales as follows: sales growth and net profit margin. Again, sales growth rate is given to you and net profit margin is given to you. Current year's revenue is given to you. Fixed capital investment net of depreciation is 30% of the sales increase. Working capital is 7% of the projected increase. Debt finance will be 40% of the investment in fixed and working capital. We have already done one such question in in this particular workbook only. Similar question has the record. Company has 12% required rate of equity. Required return of equity is 12%. Firm has 10 lakh equity shares outstanding. Calculate the value of equity momentum company using the FCFE model. Very simple, straightforward calculation, and you know, the same calculation which is there in our earlier question, same calculation will be there here as well. One important point in this calculation where you might get stuck is the calculation of terminal value. Rest all the calculations are straightforward, guys, right? Sales increase is given to you, net profit margin percentage is given to you, net fixed capital is increase in sales multiplied by 30%, working capital increase in sales multiplied by 7%, net borrowings is total of this multiplied by 40%. That is how the calculation is done. So calculation is very straightforward. Now what you will really be wondering is terminal value. How can terminal value be calculated in this particular case? That will be really an important point which is to be considered over here. Okay, so now this is the terminal value, which is terminal revenue, which is given to terminal FCFE, which means beyond 5 years, for infinite years, 204 will be the revenue at a growth rate is also important. The growth after terminal value is 5%. For calculating the terminal value, the growth is 5%. So how are we going to calculate the terminal value in this particular case? It will be 204, and mind you, these are in decimals. While printing the workbook, decimals have been eradicated, but the answer is as per the decimals only. So the answer can be little bit changed, little bit variation can be there in the answer. So I've recalculated the entire question. The correct answer will come only if you take 205 as your FCFE. 205 is the right FCFE and not 204. Okay, but still we are doing the calculation based on 204. Okay, now 204 whole divide by, we have to calculate the terminal value, right? Divide by KE minus G. KE minus G. We are not going to add G in it because G is already added. 172 to 204, G is already added in the numerator. We are not going to re-add it. Please mind this very important thing. But in the denominator, KE minus G will be there. What is KE? KE is 12% in this particular question. Okay, KE is 12%. So 204 divided by 12% minus growth rate is 5%. 12% minus 5%. This is how your calculation will be done. So 204 divided by 12 minus 5, 7%. The answer comes out to be 2914. So I told you there will be a little bit of decimal related variations which will be there, but it's okay. Okay, that is how terminal value is required to be calculated in this question. Rest everything is very same as what we have already done in our earlier question. All the calculations are absolutely the same, straightforward calculations are there. Okay, so got it. So this was illustration number 8 for all of you. Let's come on to illustration number 9. Okay, so let's start illustration number 9. Illustration number 9 again is straightforward EV to EBITDA calculation. A very straightforward calculation, no complexities involved. EBITDA is calculated using this particular calculation, guys, and you can write if you want to. This is net income, this is interest, this is tax element of the interest, and this is depreciation and amortization. If you add all these things to your net income, you will get the EBITDA. EBITDA calculation is done. Then equity, the enterprise value calculation, equity plus the net income minus cash and marketable securities minus the investments. Investments are to be reduced, and cash and marketable securities are required to be reduced. So equity plus debt, and after reducing all the cash items, marketable securities items, and the short-term debts, in the investments, you reduce the investments, you will get the enterprise value, then you divide it and you get the answer. Pretty straightforward, and the formulas are done in the class also. We have revised those several times in the class also. Same formulas are required to be used now. Very, very good question. And yes, again this question correlates to the earlier question which we have done about the book value. Okay, now if you want to calculate the market value of a particular share using the book value, then you first of all take book value as the base and add the residual income of the subsequent year discounted to the discounting factor. That we have done in our earlier question also in this workbook only. Let's see, this question is a little bit more complicated. Okay, Mr. Nath is responsible for valuing shares of Pyramid Research Laboratories. The shares are currently trading at rupees 8.75. This is the current market value of the shares. Nath gathers the following information about the company. Expected return on equity is 16%. Current book value of equity, this is the book value of the equity. Using this book value, we can calculate the book value per share also, because number of shares are also given. So I want to calculate the book value per share. Okay, I'm just going to divide the equity value by number of shares. I'll get the book value per share, and that is required. Required rate of return, cost of equity, required expected return on equity 16%, cost 12%. So what is the residual income? Residual income is 4%. What is the residual income? Residual income is 4%. So 16% is the expected return, cost of equity is 12%, so the residual income is 4%. We have already done this kind of question before also, guys. So what I'll do is BVPS plus the residual income of the future years discounted to the present value. Okay, so alright, no dividends are paid, so it's a no dividend company. Dividends are not paid. All earnings are reinvested, so whatever we earn, we reinvest in our own shares. Now that is the strategy. Continuing residual income 0 after 4 years. So after 4 years there will be no residual income. So there will be no income after 4 years. The income will be 0. You have to calculate the intrinsic value. Most likely recommendation Nath would be issued at the stock of PRLR. So at this intrinsic value, if these are the intrinsic value, then these are the recommendations which will be given for these particular shares. But we are not bothered about these recommendations as of now. Our ask is to calculate the intrinsic value of this particular share. According to our calculation, what will be the price of this particular share? That is the thing which we need to compute. Okay, now this is a complex table which is given to you. We can do these calculations in a easy manner also. First of all, this first column is absolutely of no use. Okay, so the simple thing that we need to do is, please look at this. Value per share is equal to the current book value per share, the current book value per share plus the residual income of the future years discounted to the current period. The residual value of the future years discounted to the current period. That is the formula which we are going to use, which we already used in one of our earlier questions also. Now, simple, 7.25 is the current book value per share. How did we calculate it? We calculated using the information given in the question. 4350 divided by 6 crore, 7.25 per share is the current BVPS. Now guys, what is the BVPS after 1 year? This is the current BVPS. What is the BVPS after 1 year? The BVPS after 1 year will be 7.25%, 7.25% plus the return which is expected from this share, which is 16%. We're going to reinvest in our company itself. So the future BVPS will be 8.541%. How did we calculate it? 7.25 plus 16%. 7.25 plus 16%. 8.41 will be the BVPS 1 year hence. Further, we are going to add 16% more, then we'll get 9.76. This is the book value per share of the future years. Okay, so 7.25% plus 16% is 8.41. 8.41 plus 16% is 9.76. 9.76 plus 16% is 11.32. 11.32 plus 16% is 13.13. So these are the BVPS of the future years. They will get us a return of 4%. Okay, BVPS multiplied by 4%. So residual income will be the income which will be there with us will be 4% of these numbers. So this is the current BVPS. We are not taking income for this particular year because this is the current year. The income is already is not there at all. In the next year, the income will be 8.4%, 8.41, which is the BVPS multiplied by 4%. 4% is 16% minus 12%. This is the residual income, right? So the income for the next year will be 8. So the income will be calculated first of all using 7.25 BVPS. So 7.25 multiplied by 4%, it will give you an income of next year of 0.29. BVPS is the current year's value. This is the current year's value. After 1 year, the income will be earned on this BVPS 7.25, which is 0.29. So how do you calculate 0.29? It is 7.25 multiplied by 4%. So after 1 year, the income will be 0.29. Now, after 1 year, the BVPS will be 8.4%. So after 2 years, the income will be 8.41 multiplied by 4%. So 8.41 multiplied by 4%, 0.34. Then 9.76 is the BVPS after 2 years. So after 3 years, the income will be 9.76 multiplied by 4%. This is the third year income. And the BVPS of third year is 11.32. So 11.32 multiplied by 4% is the income which is after 4 years. 11.32 multiplied by 4%. This is the income after 4 years. And after 4 years, there will be zero income. No residual income will be there after 4 years. That is how calculation is required to be done for the next 4 years. This is how the calculation is required to be done. Yes. This equity charge is nothing but the cost of equity, which we are taking it as 12%, right? This RO is already 16%. So first they are calculating the equity charge in rupee terms, and then they are subtracting from value. What I've done is I've done a direct calculation. Direct calculation means 16 minus 12. 4% is the residual income. So whatever is the value multiplied by 4% will be the residual income of the ensuing years, and that is why the calculation is done in that manner. So yes, you can do the direct calculation also. The concept should be clear to you whether you do direct calculation or whether you do calculation according to the method which is given in the question. Both are equally correct and both are acceptable in the examination also. Okay, so we have calculated the present value of, we have calculated the residual value for next 4 years. After 4 years, there will be zero residual value. So after 4 years, there will be no residual value. Since after 4 years, there will be no residual value. So in this particular question, terminal value is not required to be calculated. There is no terminal value concept which will be there in this particular question. You just have to calculate the present value of the cash flows till 4th year. Now in this question, there is a complexity which the question has inserted, which according to me is not required. There is a straightforward way of doing this particular question. So 7.25 is the base BVPS. We will add all the residual incomes of the future years multiplied by their discounting factors. We will discount it. So 0.29 discounted by 1 year, discounted for 1 year, 0.34 discount for 2 years at 12%. Now over here, the calculation has been a little bit complicated by the institute. They have calculated the residual income of 4th year, 1 plus R minus the factor. So they have computed 0.4 is the value. Instead of doing this step, I think this step is not required at all. What you simply have to do is 0.39 divided by 1.12 raised to the power 3 plus the income which is there, 0.45 divided by 1.12 raised to the power 4. The answer will absolutely be the same. The answer will absolutely be the same. So you employ the easier way. Don't go into this calculation. This will confuse you. This is a useless calculation. So don't go in this calculation at all. You just use this calculation, 7.25 plus this factor plus this factor plus this factor plus this factor, 0.05 which is 4th year's income, divided by 1.12 raised to the power 4. Your answer will absolutely be the same, which is 8.34. Take the easier route. Okay. Over here also take the easier computations. It will be much easier, easily comprehensible by all of you. So why doesn't institute take the easier way? Why does institute take always the difficult way? That is because some bit of pressure is required to be created on the students. Okay, it is not that, you know, institute is only wanting you to pass. Institute is also wanting you to, you know, fail also. Obviously, guys, any professional body doesn't want 100% as its results, because if it gets 100% results, then definitely the professional body is at a loss. The profession as a whole is at a loss. So they don't want 100% results for sure. Alright, let's start illustration number 11. Alright, illustration number 11 has two new concepts. So let's read this question very carefully. An analyst is examining a private firm under consideration as an acquisition and determines the following. The current capital structure is not optimal because the owner avoids use of debt. Use of debt is not there. Small stock premium and company specific risk premium are given to you. So small stock premium means since it's a small company, there's a additional risk to it as compared to the industry risk. And this company specific risk, which is additionally there in this particular company, are determined because the private firm is much smaller and much less diversified than the public firms that beta is estimated from. Okay, these are company specific risks. The industry risk premium reflects the additional risk of this industry compared to the broad market. So risk free rate is given to you, then equity risk premium is there given to you, and beta is given to you. So using these three and using the CAPM model, we'll calculate the cost of equity. But over here, three more risks are given to you. Three more risk premium are given to you. This will enhance our cost of equity further. These are additional risk apart from the normal risk. These are additional risks. So this will enhance our cost of equity further. That is the role of these three risks which are there, which is small stock premium, company specific premium, industry risk premium. This will increase our cost of equity. Pre-tax cost of debt is given to you. Debt is to capital, total capital. The industry norm is given to you. Optimal debt to total capital is given to you, and the current debt to total capital is given to you. Okay, debt to capital ratio is given to you of the industry as well as what should have been there and what is currently there. All three are given to you. Tax rate is also given to you. Calculate the required return on equity. Okay, you have to calculate the required return of equity using three methods. Number one, the normal CAPM method, which we have already studied. Expanded CAPM method, which we have not studied. And third is the built up method, which we have not studied in our regular study mat. But very easy, very straightforward, guys, don't worry. Calculate the WACC using the current capital structure and the optimal capital structure. So you have to calculate the weighted average cost of capital using the current structure as well as the optimal structure. Comment on the appropriate capital structure weights. Okay. Now, the first task is to compute the required rate of return using CAPM. CAPM is straightforward. You use three variables and we just, using this formula, compute our CAPM cost of equity. Simple. Now, two more methods are required to be employed while calculating the required rate of return. Expanded CAPM, which means we'll add two more factors, small stock premium and company specific premium. And there's a built up method also. Okay. In the built up method, we'll add one more risk premium, which is the industry specific premium. So please note these 2 points. These two premiums are to be added while computing the expanded CAPM. Expanded CAPM. These two premiums are to be added, and all three of them are to be added while calculating the built up method. All three of them are added to calculate the built up method. Okay, that is the only change which is there. Okay, so what we have done is we've taken the current return on equity, which is 11.4% is the return on equity, and we have added the risk premium, the two risk premium, to get the expanded CAPM model. This is the expanded CAPM model. And the built up method, in the built up method, what we'll do is we'll take the raw form of risk free rate of return, which is 3.6. We'll start from 3.6. We'll not use the CAPM method. Okay, we'll not use the CAPM method. We'll individually add all the risks which are associated with this particular company. 3.6 plus 6 plus 3 plus 2. 3.6 plus 6. 6 is the equity risk premium plus 3 plus 2 plus 1. That is the built up method. In that, CAPM formula is not required to be computed. So this is a new thing which we have started. There are two more methods: expanded CAPM method and the built up method to compute the the cost of equity. Alright, beyond that, the calculation of WACC is absolutely straightforward, and the conclusion is also absolutely straightforward. So nothing new in the rest of the question. Yes, nothing new in the rest of the question. You have to calculate WACC using two capital structures. One is the optimal capital structure and one is the current capital structure. Both are different. Debt equity ratio is different. Therefore, the answer will be different. So, WACC is required to be calculated in two ways. Same formula, guys. Weight of equity multiplied by rate of equity. Weight of debt multiplied by rate of debt multiplied by 1 minus tax rate. That's how. And this is the conclusion which we are required to read. Okay, got it? Illustration number 12. Okay. Illustration number 12 is again calculation based question, guys. Nothing critical, no point is difficult. It's just a calculation of the free cash flow from the firm. So you have to calculate the free cash flow of the firm for the next year from the following figures. Assume the earnings and expenses are normalized and that the capital expenditure equal the depreciation plus 4% of the firm's incremental revenue. So it is the catch is that just that capital expenditure is to be calculated using the depreciation plus 4% of the incremental revenue. That is the formula which is used to calculate the capital expenditure. That's the only catch in this question. Otherwise, question is simple. So current revenue is given to you, growth rate is given to you, revenue growth rate, gross profit margin is given to you, depreciation as an expense of percentage of sales is given to you 1%, working capital as a percentage of sales is given to you 12%, selling expenses is given to you and tax rate is given to you. You have to calculate the, after 1 year what will be your FCFF, that is what you have to calculate. So revenue will take including growth, cost of goods sold. So, gross profit margin is given to you. According to that, you can take your cost of goods sold, which is 20%. Okay. Then we have gross profit. Then we have selling expenses already given to us. EBITDA is, calculated. Depreciation amortization is 1% of the sales figure multiply 1%. Yes, depreciation is given as a percentage of sales figure. That is the, critical point over here. Then working capital is also given as a percentage of sales figure. EBIT is given, tax on EBIT, operating income is given. We'll add back depreciation and amortization because we need to compute the FCFF. We'll add the capital expenditure. Capital expenditure is 4% of the revenue plus the incremental revenue. 4% of the incremental revenue plus the depreciation and amortization. Okay. So depreciation and amortization plus 4% of the incremental revenue. Incremental revenue is only 5 lakhs. From 1 crore 5 lakhs, from 1 crore it has increased to 1 crore 5 lakhs. So incremental revenue is 5 lakhs. 5 lakh multiplied by 4% plus the amortization and depreciation, that is the capital expenditure which you are going to reduce, and we'll get the FCFF. So calculation is straightforward, just a little bit of hiccups over here which I have explained. Okay, sir, got it? So this was illustration number 12. Alright, illustration number 13 is also a straightforward computation. Phoenix Limited reported a profit of 87 lakhs. After tax. Okay, now I have to calculate the profit before tax. I'm going to add on the tax element to it to get my before tax figure. Financially is given to you. Analysis of accounts revealed that income included extraordinary income of 10 lakhs, extraordinary loss of 14 lakhs. So in this, once I have computed the PBT, then I'm going to add the extraordinary expenses and reduce the extraordinary incomes. But before that, I have to calculate the PBT. Existing operations except for extraordinary items are expected to continue in future. So the same financials will be there in the future as well, in addition to result launch of new product. So this is the new product which is going to be add on to our business along with the existing revenue. Calculate the value of business given that capitalization rate is 14%. So the existing business plus the new business, total of both of them capitalized, that is the value of the business. So profit before tax will compute 87 divided by 1 minus 1 divided by 30. Less extraordinary income, add extraordinary losses. This is the future maintainable profit, which is 128. Then we'll have profit from our other business also, which has come to 34. So total is 162 is the total profit from both the businesses. Then tax rate reduction, future maintainable profit, capitalization factor. Then we'll calculate the value of the firm using capitalization. Okay, simple method. Market price you'll be able to calculate yourself easily. Okay, sir, got it. So this was illustration number 13. All right, yes. Illustration number 14 has got a little bit of catch for you. Just a number play, guys. Just a number play. Formula is the same. The concept is the same. Just a number play, which is there in question number 14. Valuation of Rohit Limited has been done by investment analyst based on an expected free cash flow of 108 lakhs. So there's a free cash flow of 108 lakhs. For the following year, an expected growth rate of 9%. So the expected growth rate is of 9%. The expected free cash flow is 108 lakhs. The analyst has estimated the value of Rohit Limited to be 3600 lakhs. The value of Rohit Limited is 3600 lakhs. based on the cash flow of 108 lakhs and the expected growth rate of 9%. However, he committed a mistake of using book values of debt and equity. Now, the problem which Rohit has done is that he has used book value while calculating the value of the firm. The market values are a perfect way of calculating the value of the firm, and he has used the book values. It's not wrong, okay, it's not wrong, but the question requires you to calculate the value as per the market values. That's the only thing, okay. The book value weights employed by analysts are not known, but you know that Rohit Limited has cost of equity of 20% and post-tax cost of debt of 10%. We don't know what is the market value, but we know that cost of equity and post-tax cost of debt is 10%. The market value of the equity is thrice its book value. So if you give me book value of the equity, then I'll multiply it by 3 to get the market value. And the market value of debt is 9/10 of its book value. What is the correct value of Rohit Limited? You have to recalculate the correct value of Rohit Limited using the market value of debt and equity. Now guys, the ask in this particular question is to compute the book value of debt and equity. Once you compute the book value of debt and equity, I will revise it to market value of debt and equity and do the entire calculation again. That is the way the question has to be approached. Okay, sir. All right. So first of all, cost of capital, applying free cash flow to the model, we have to calculate the cash flow. First of all, what will be the cost of capital is required to be calculated using the free cash flow method. So this formula we are using, value of firm is equal to free cash flow divided by KE minus G. That is the formula. At one level the valuation is already done. 3600 has already been calculated as the value of firm. So we'll do a reverse calculation. Okay. So INR 3600 is equal to the free cash flow which is already given to us, 108 lakhs. 108 lakhs is the free cash flow, and we divide by KE minus G. We don't know the KE, right? We don't know the KE, the cost of capital, but we know the growth rate. Okay. So growth rate is 9%. Growth rate is 9%. So by applying a reverse formula, we are going to calculate the cost of capital. Okay. 3600 is the value of the firm. 108 lakhs is the free cash flow. Cost of capital is not known to us. Growth is given to us. So using the reverse formula, we are going to calculate the cost of capital. Cost of capital is computed as 12%. But this is a wrong cost of capital. Why? Because it is taken as per the book value. We need to calculate the cost of capital using the market value and recalculate the entire value of the firm. Okay, sir, we'll do it. So this is the cost of capital, 12%. Now we'll further disintegrate this cost of capital into cost of debt and cost of equity. See how? Very interesting number play. Just a number play. Mathematics, pure mathematics, guys. Now let X be the weight of debt. X is the weight of debt. Given that cost of equity is 20%, cost of debt is 10%, then this is the formula. Please see the formula, weighted average cost of capital. 20% multiplied by 1 minus X. If X, weight of debt is X, then weight of equity is 1 minus X, right? Weight of debt is X, weight of equity is 1 minus X. So 1 minus X multiplied by 20%, which is cost of equity, and X multiplied by 10%, which is cost of debt post-tax, is equal to 12%. 12% is the cost of capital, right? So we get the debt, weight of debt. Weight of debt is 80%, and weight of debt is 80%, and weight of equity is 20%. So weight of debt is 80%, weight of equity is 20% based on the book value. Please note, this is based on the book value. Reverse disintegration of the numbers is being done in this particular question. So weight of debt 80%, weight of equity 20%. This is the book value based on weight, right? Now these are based on book value. We need to compute the market value weights, and for calculating the market value weights, let's see what is the information which is given to us. The market value of equity is thrice its book value. Thrice its book value. So assuming that market value of the book value of equity is 20. So what is the market value of equity? Thrice its value, which means 60 is the weight of equity, market value 60. And the book value of debt is 80%. What is the market value of debt? It's 8 by 9 of 80%. Sorry, 8 by 10, 9 by 10 of 80%. Let's read once more. The market value of its debt is 9/10 of book value. 9/10 means 80 divided by 10 multiplied by 9. 80 divided by 10 multiplied by 9, which is 72. Got it? So the correct weight of equity is 60. Correct weight of debt is 72. Correct weight of debt is 72. That's how you calculate the debt and equity weight based on market values. This is based on market value. So 72 is the market value of debt and 60 is the market value of equity. 60 to 72 is the ratio now. 60 is to 72. Yes, 60 plus 72 is 132. And now very easily guys, very straightforward, we'll calculate the correct cost of capital based on weights, which is 60 is to 72. This is the weight of equity and debt based on market values. Thrice the book value is the weight of debt and 9 by 10 of the equity value is the equity. So 60 is to 72 is the correct ratio of debt is to equity. Okay, so this was the critical point in this particular question. Basically a number play. Okay, number play is important because in examination number play definitely has got some value, some weightage is given to number play. More weightage should be given ideally to concepts, not number play. But yes, sometimes question comes when number play is important, concept is not that. So concept was not WACC simple formula is applicable, but number play, disintegration of the old cost of capital and then revising the weights and then again calculating the cost of capital, that was the critical part in it. But once you do it, then if it comes in the examination, it will be a cakewalk for you. So, if any of these questions come in the examination and you have practiced it from your workbook, it will be a cakewalk for you. I know time is less, but guys, practice as much as you can this entire workbook, and even if one question comes from this workbook, it will be worth it. I know you will take say 3 hours or 4 hours to complete the entire workbook. You will take this much of time, but it will be worth it. Both cost audit and BVM, SPM. Okay, so got it. Let's move on to illustration number 15. A very simple question of impairment of assets. So guys, the concept of impairment of assets says that the assets book value minus the value in use, okay, and not the realizable value, is the impairment loss. Impairment loss means our book value is too much, in our books of accounts the value is too much, and the benefit that this asset is going to give us, which is value in use, is less. Differential can be set off as impairment loss. That is the idea. Now, to make things difficult for you, along with book value, they have also given the fair value of asset. Now, fair value of asset is irrelevant. Please note, fair value of asset is irrelevant. While impairing the asset, we don't use the fair value. We only use two things. One is the book value, which is the purchase price minus depreciation, 7,000 minus 1,800, that is the book value. Second is the value in use, which means if we use this value, what income is going to be generated. So the differential of both of them is taken as the impairment loss. 700 is the impairment loss. Okay, and this is irrelevant. 4480 is irrelevant. This is just an information which is given, otherwise it's irrelevant. Okay, so that is how the question is to be done. A straightforward question. Impairment loss. Ideally this question should have been given in valuation of assets and liabilities, which is there in our module, but it's okay. Okay, now let's come on to the next part of the module, illustration number 16. Okay, a very straightforward question of EVA, economic value added, NOPAT minus WACC multiplied by capital employed. Capital employed information is given to you in terms of equity, reserves, long-term debt. Capital employed information is completely given to you. Then NOPAT is to be calculated by you, and simple application of EVA formula and your EVA is calculated. Illustration number 16 is very easy. This is very simple and straightforward. Alright, let's move on to our next module, module number 4, valuation of assets and liabilities. Okay, the first question is of copyright. The intangibles, we need to calculate the value of copyright. Again, basically a calculation based question. Bloomsbury India, the current publisher of the book Handbook on Valuation of Securities and Financial Assets by Vikash Goyal, is willing to sell copyright of this book to another publisher who is keen to buy the copyright. The following assumptions may be relevant. The current price of the book is 3,000 and the sales is 6,500 copies. So 300 multiplied by 6,500 is the revenue. Annually sale is happening. The cost of production, distribution, author royalty amounts to 70% of the sales. So the cost is 70% of the sales value. The book is becoming popular. Publisher estimates the sales of book may be increased by 5% every year for next 5 years. So the increase will be 5% every year. This is including the newer edition of the same book. However, after 5 years, given the introduction of other books, On the same subject, dilution of exclusivity, violation of copyrights and plagiarism, there may not be any increase in the sales. So there will not be any increase in the sales after 5 years. So sales will become constant after 5 years. No increase in growth. Okay. But the sales may be stable at the same level as at 5 years. So sales will be stable at same level as 5th year. The growth will be not there. Assuming a discount of 10%, we can assess the value of the copyright. We have to assess the value of copyright. We have to assume the discount rate of 10%. Okay. So yes guys, first of all, we'll start with the sales. Sales increase number is given to you. First year sales, current sales is given to you, then the increase number is given to you. 5% is the annual increment. So you keep on adding 5% to these numbers to get the subsequent numbers. 5% is added to get the subsequent numbers. Simple. That is the sales figure. Then we reduce the cost from it, cost of whatever costs are there. We're going to reduce the cost. Costs are also mentioned in the question itself. So it says that the royalties and distribution production will cost 70%. 70% of the sales is the cost. So we'll calculate the cost accordingly. This we get as the free cash flow from equity, and we'll calculate the terminal value as well. So the terminal value is the last year's revenue, which is equal to the 5th year's revenue, divided by 10%. No need to reduce growth in this because there's no growth in the subsequent periods. Okay. So terminal value will be divided by 10%. So this is the terminal value. The discounting rate will be the same. Okay. And here we calculate the value of equity. This is how the value of equity is required to be calculated. Okay. So straightforward question or simple question. Again, a copyright related question. And in this question, there's a fair bit of complication which has been inserted in the question by introducing the working capital adjustments, and the fair value of fixed asset is given to you, book value of fixed asset is given to you, normalized earning of the firm, the usual earning of the firm, the current earning of the firm is given to you, required return on fixed assets. So on fixed assets, the required rate of return is given to you. Return on intangible asset is something separate. Weighted average cost of capital, required return on working capital is also given to you, 6%. Required return of intangible assets is 20%. Long-term growth rate of the residual income is 10%. What is the value of Agrawal's intangible asset? You have to calculate the intangible asset value, and you have to calculate the market value of invested capital. Market value is required to be computed. So, the method which is to be employed is the super profit method in this particular case. Okay. So how do you get to know that this is the super profit method which we need to employ? So guys, the question specifically gives you excess earnings method. What is the excess earnings method? It is the super profit method. You need to calculate using the super profit method. So super profit method is the actual profit, which is this profit minus the normal profit. This is the actual profit minus the normal profit, which should have been there. Okay. This is how excess profit is required to be calculated. All right. So normalized profit minus the actual profit, normal profit. This is normalized in earning means the current actual earnings of the organization, and these are the normal earnings. Normal earnings will be calculated using return on working capital. Return on working capital is 6% of 25 lakhs, and the required return on fixed asset is 9%. Okay. So 9% is required to be taken. So 85 lakhs multiplied by 9% is 7,65,000. Okay. Yes. 85 lakhs multiplied by 9%. This is the normal earning which this kind of business should earn. Total of these two are normal earning which this kind of business should earn, but it is earning 30 lakhs, way beyond. This is the super profit. Okay. So current excess earnings into growth rate is the projected residual income. Growth rate is 10%. This is the future income. So this is the super profit 1 plus T of the next year, and we capitalize it using the formula KE minus G. KE minus G is to be put in the denominator to get the capitalized value of the entire intangibles. So this is the capitalized value of the intangibles, intangible asset. Now if you want to calculate the market value of invested capital, then you take the working capital, you take the fixed asset on the fair market value plus the intangible asset to get the entire value of the business. Okay. So just an addition to the initial question that we have done. That's just an value addition. Okay, so got it. Illustration number 3, net operating income for an office building is expected to be 2,25,000, appropriate capitalization rate, estimated market value of property. This is so simple, guys. 2,25,000 divided by 7.5%. So very, very easy question. This question is, a good question. And again, a concept which we have done in class thoroughly, valuation of bonds. But this question will have an edge because it is little more complex than the usual question because of the compounding variation rate. So I'll explain you how. Okay, let's read the question first. A corporation issues INR 1,000 par value bonds. Okay, now they are to be compounded. The interest is to be compounded semi-annually, bearing coupon rate of 10%. So coupon rate is 10%. Semi-annual compounding is there. Matures after 15 years with an expected return of 12%. 12% is the IRR, internal rate of return, which is expected from these particular bonds. Find the value of the bond. The current value of the bond is required to be computed by you. Okay. Now the bond will give you semi-annual interest. What is the semi-annual interest? Semi-annual interest will be rupees 100, which is 1,000 multiplied by 10% divided by 2. So semi-annual interest will be 50 rupees. Okay. Now according to this particular calculation, the tenure will be 30 and not 15 because it will be twice, because 2 times the interest is to be given. Okay, so tenure will be 30, not 15. 15 multiplied by 2. And what will be the rate of return? The rate of return will be 6%, half, because it's per annum. This is per annum. 12% is per annum. So I've reduced it to half, 6%. Okay, because I need to do compounding. I need to calculate the discounting factor. Therefore, I'm taking the exact measurements to enable myself to do the discounting. That is how it is done. Okay, so 50 is the interest which I'll earn at regular intervals. 30 such interest will be received by me. Rate of return will be 6% because semi-annual disbursal of interest will be there. So instead of 12%, I'll take 6% as the return on these bonds. Okay. Okay, sir. Now the value of the bond is computed as this particular complex formula, but it's not that complex, guys. It's a very, very simple formula, very, very easy formula, and I'll tell you how this easy formula is to be taken by you. Okay, now forget about this complex formula. We have 2 cash flows. One cash flow is rupees 1,000 that we are going to get, and at the end of 30 periods, at the end of 30 periods, we are going to get this particular cash flow. Okay, so I'll divide this cash flow by 1.06 raised to the power 30. Please note this calculation that I've done. 1,000 divided by 1.06 raised to the power 30. 1 divided by 1.06. Some mistake. 1, 2, 3. 1 divided by 1.06. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. Alright. So it gives me a figure of 0.714. So I'll write 1,000 multiplied by 0.174. So what is the present value of 1,000 which we will receive after 6 years? Present value of 1,000 which we will receive after 6 years is rupees 174. Now we're going to add the interest element to it. The interest which we are going to get in all these years is 50. Okay, and we are going to get this interest for semi-annual purpose for 30 tenure. 6% is the rate, and this time we are going to add it using a summation of 1 to 30. This will be present value annuity factor. Please remember, this is present value annuity factor. This is not the same present value factor. I hope you know the difference between present value factor and present value annuity factor. This is present value annuity factor. Okay. Now we are going to calculate present value annuity factor. 1 divided by 1.06 for 30 years totaled together. Okay. We are going to do m plus m plus m plus m plus. If you have GT in your calculator, that is the best. Okay, so 1 divided by 1.06. I don't have GT, so I'll do equal to m plus equal to m plus equal to m plus. Okay, so equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. I'll do an MRC. Okay. This gives me a figure of 50 multiplied by 13.765. 13.765 multiplied by 50. This gives me a figure of 688.24. So this is the present value of the interest. This is the present value of 1000. This is the present value of interest. So 688.24 plus 174. The present value of the share is computed as 862.24, which is same as our answer. Minor decimal differences. Okay. So the formula is the same, but just that instead of mugging up this complex formula, why don't you apply the simple present value, annuity factor and present value factor concepts which are there in our syllabus? Why don't you employ that? Because that's much more easier. It's much more straightforward. Okay. So I calculate the present value of these bonds by using, first of all, I'm discounting the maturity value. Then I'm discounting the interest which I'll receive. Just the difference is that this will be discounted using present value factor. This will be discounted using present value annuity factor. That's the only difference between the two, and your answer will be solved. 8062 is the correct answer. Okay. So it's just that, in the examination, don't get fussy over formulas. Be fussy over concepts, and then whatever method suits you, you can do that. Whatever method is comfortable to you. All right. A similar question, valuation of bonds, illustration number 5. Again, little bit of complexity over here. Following data available for a bond. Face value is ₹1000. Coupon rate is 15% annually, not semi-annually, annually. Thank God, the complexity is reduced. Years to maturity, 5 years. Redemption value is also given to you. Okay, 1000. And the current market price is also given to you. In the last question, we had to calculate the current market price. But in this question, current market price is already given to you. So what is the ask? Ask is you have to calculate the yield to maturity. You have to calculate the yield to maturity. So till maturity, what will be your expected rate of return if this is the current market price, this is the redemption value, and these are the details of interest. That is the concept that is asked from you. Okay, so we'll do that. We'll compute the yield to maturity in this particular case, and the formula which we'll use to calculate the yield to maturity is that first of all, tell me what will be the annual income that we are going to get. Okay, so the formula of yield to maturity will be annual income which you are going to get from this particular this particular share. Income per annum, that will be a better remark. Not annual income, but income per annum. Okay, and this divide by average investment, opening and closing investment. Okay, so that is the formula which we'll use to calculate the YTM, years to maturity. Now income per annum is, we are going to get first of all the interest. Interest is 150 rupees. So annually we are going to get the interest. Interest is 150 rupees. What else are we going to get? We are going to get the differential of the current market price and the future value. Differential of both of them will be earned by us, which means 1000 is the maturity value, current price is 964, and we are going to split it in 5 years. Over 5 years we are going to split it. Over 5 years we are going to split it because the maturity value is 5 years. So over 5 years we are going to split it. So 150 plus 100 minus 964.7. This is the current market price. This is the maturity value. This differential will also be the income that we have earned, right? Divide by average investment. Average investment means, as of now you have to spend 964.07. 964.07. In future you're going to get 1000. So I'm going to do a average of both of them. 964.07 plus 1000, which is the future value, divide by 2. Divide by 2. That's how we are going to take average of both of them. Okay, and this is how we are going to calculate the YTM. Let's calculate. 1000 plus 964.07. 964.07. Minus not plus. 1000 minus 964.07 divided by 5. 7.186 plus 150 gives me 157.186. Divide by 964.07 plus 1000 divided by 2. Gives me a figure of 16%. So yield to maturity is computed as 16%. Yield to maturity is computed as 16%. There is another method for calculating the YTM, which is the interpolation method. Interpolation method. Using the interpolation method, you calculate the NPV at two different rates. First, you calculate the NPV say at 10%, then you calculate the NPV say at 20%, and then we are going to interpolate the returns which are there on these particular numbers to get our 16% number. That is also another method. That is also one of the methods. Okay. Now, the question has done the calculation using this method, which is the average investment method, but they have taken the averages slightly differently. Okay. So, maturity value they have taken at 40% and price they have taken at 60%. They have changed the constitution of weight that they have given. I have given weight as 0.5 and 0.5. I have given weight as 0.5 and 0.5. The answer has given weight as 0.4 is to 0.6. Now, according to me, unless until question specifies these weights, we cannot change this. We should not change these weights. These weights should be 0.5 and 0.5 only. However, the difference is really minuscule and the answer is almost the same. There's difference in decimals, guys. So, it doesn't matter. Doesn't matter. According to me, it doesn't matter. But yes, average investment is a fair point to be taken. Okay. So, first part is absolutely clear. Yield to maturity is 16%. 16% is the rate of income that we have received. The second is the duration. Duration means till what time will our initial investment be recovered. So, total duration is 5 years for these bonds, but till how many years at least our initial investment will be recovered, which is 964.07. This will be recovered. What is that duration within which this 964 will be recovered? That is the duration bit. For that, we have made a simple calculation. We have calculated the cash inflows. We have discounted it using the 16% rate. We have used the present cash flow of the present value of the cash flow. Then we have calculated the proportion of the present value. Proportion of present value is calculated as 129.31 is earned out of 967.26. 967.26. So this divided by this is 13%. 13% is recovered in the first year. Okay. Then 111.47 divided by 967. Another 12% is recovered in the second year. Another 10% is recovered in the third year. Another 82.84 is recovered in the fourth year, which is 9% is recovered in the fourth year. Then 57% is recovered in the last year. So this is how recovery is done. Okay. Now simply, if you have to calculate the duration within which at least the major part of it, the exact current value is recovered. If you want to calculate that, we are going to multiply time with this proportion. So 1 multiplied by 0.3 is 0.3. Then 2 multiplied by 0.24 is 2.24. Then 3 multiplied by 0.1 is 0.30. 4 multiplied by 0.9 is 0.34. Then 5 multiplied by 0.57 is 2.83. We're going to add all of them and we'll get the exact number of duration within which at least the current price will be recovered. 3.84 years and the current investment is recovered. Over and above, we'll get the profit. Okay, so that is how duration is required to be calculated. This is the calculation of duration. Okay, sir, got it. So this is how we just multiply the time by the present value proportion to get our duration within which our initial investment will be recovered. Then what is the volatility? Volatility means the dynamism which is there in the share price, in the bond price in relation to the time. So the formula is duration within which our initial investment will be recovered divided by 1 plus YTM. This is the volatility which is computed 3.31. Okay, sir, got it. Okay, so yes, again word play is there, number play is there. All right, next one is quite simple and easy. EVA is required to be calculated, right? EVA standard formula, NOPAT minus WACC multiplied by capital employed. Same formula is required to be put over there. NOPAT is calculated using operating profit before interest multiplied by tax rate, which is 30%. Corporate income tax is 120 over the 1000. So 12% is the corporate tax rate. So 88% is the net of tax income. Okay. So a straightforward formula, guys, a straightforward question. No PAT is required to be calculated. So 880, I'll just tell you. Okay, this is 1000 multiplied by 88%. Where do we get 88% from? It is 12% of the tax rate. Tax rate is 12% over here. Okay. The second year tax rate is 10%. Third year the tax rate is 200 divided by 1800. It's 11.1111. This is the tax rate in the third year. Okay, so we have accordingly calculated the no PAT of all the years, and WACC is also calculated, and we are just applying the formula to get the EVA in INR lakhs. Okay, so got it. Illustration number 7, again EVA and MVA related question. EVA and MVA is required to be calculated. No complexity in the question at all. No complexity, guys. EVA formula, straightforward application. Okay. MVA formula, straightforward application. So guys, don't think that since I am saying it's easy for you also. If you get stuck at any of the point, please you can raise your query to me, and my query number 9643929913. This is my query number. You can raise your query to me. MVA and EVA both you can undertake. Alright, sir, got it. So illustration number 7, quite straightforward and easy calculation. Okay, illustration number 8, we need to discuss it briefly. Given the following figures, calculate the value of the firm. Value of the firm is required to be calculated again using the super profit method. Using the super profit method, value of the firm is required to be calculated. Working capital is given to you, fixed assets is given to you. Normalized year earning, which means actual earnings which are there, 1,30,000. Required return for working capital and required return of fixed asset, and growth rate is given. Discounted rate of intangibles also given to you. Again, working capital income, fixed capital income and excess earnings are calculated as 12,000. Using formula growing perpetuity, we calculate the value of intangibles. Growth rate is 5% and the intangibles rate is 14%. 12,000 is the super profit. This is the super profit which is attributable to the intangibles. Super profit means that something which is not given in our fixed assets and working capital is having a role to play, which is intangibles. Okay, simple, straightforward, easy calculation, guys. Just that sometimes the words which are used are a little complex. Words which are used are complex. Normalized earning, it's a complex word which is new to you, so it's a good way to understand these words as well. Okay, yes, last question of this module, illustration number 19. Only one complex part which I'll be discussing in this particular question. Saket Limited has developed a high-tech product which has reduced the carbon emission from burning of the fossil fuel. The product is in high demand. The product has been patented and has a market value of 200 crores. So the market value of product is 200 crores, which is not recorded in the books. Books doesn't have this value, 200 crores. The net worth of Saket Limited is 400 crores. Long-term debt is 600 crores. Okay, equity is 400, debt is 600, so total 1000 plus 200 worth, which is not recorded. So 1200 worth of this company. Product generates net operating profit after tax of 140 crores is the net profit after tax. The rate of 365 government bonds is 10%. This is risk-free rate of return. Market portfolio generates 12% per annum. This is RM. Okay. The stock of the company moves on tandem with the market. Now, this is a very critical information, guys. The stock of the company moves in tandem with the market. So, stock is directly correlated with market. If market moves by 2%, stock will also move by 2%. What does this imply? It implies that beta is 1. Beta of this company is 1. And if beta of some company is 1, then the market rate of return is equal to the cost of equity of that particular company. You can calculate also. You can calculate beta 1 of any company. Market rate of return will be equal to the cost of capital. Both will be the same because beta is 1. So in this particular case, beta is 1. So I can safely assume that 12% will be my cost of capital also. Okay, sir, got it? Yes. Rest, everything is absolutely in place. Weighted average cost of capital is required to be taken. Cost of equity 12%. Weight of equity. Cost of debt, weight of debt. We calculate the WACC and we calculate the EVA after that. EVA is also the straightforward computation which we usually do. Alright guys, let's move on to our last module, which is merger and acquisition, and of course very important module. Why? Because you can expect questions worth 10 marks, minimum 10 marks from this module. This module is even more important than the basics of valuation and valuation models, even more important than that particular module. So very important from an exam standpoint. Okay, illustration number 1. The following information is available for Mr. Jain for the year 2000. Outstanding debt is given to you. Share price, number of outstanding shares. If you multiply these two, then we will get the market value of equity. Then we have net income. We have EBIT. Okay, net income is given to us. Net income means profit after tax. And EBIT is also given to us 120. Interest expense is given to us. Capital expenditure, depreciation, working capital, growth rate of EBIT for these years 7%, and growth rate beyond 2005 is 4%. This is for calculating the terminal value. Okay, free cash flow 135, cost of equity 15%. The capital expenditure is expected to be equally set off by depreciation. So capital expenditure, depreciation are equal in future. Debt ratio is declined by 30% in 2005. Debt ratio has declined by 30% in 2005. You are required to calculate the value of the firm and the value per share. Is the company undervalued or overvalued according to you? Okay, so now value of firm is required to be calculated, and the value of firm is to be calculated using the free cash flow method. Okay, so free cash flow method is to be used to calculate the value of the firm. This is how the value of firm is required to be calculated. Of course, terminal value and the per year value is required to be calculated. Okay, let us see the calculations once. Now, tax rate is not given in the question. If tax rate is not given in the question, then we'll calculate the tax rate using our numbers. Okay, so EBIT is given to you 120, interest is reduced from it to get the PBT, profit before tax. Profit after tax is already given to us in form of the net income 7.75. Okay, so the tax paid is 6, which is PBT minus PAT, and 6 over EBIT, 6 over 120, sorry, 6 over 13.75. 6 over 13.75 will give us the tax rate. So tax rate is 44%. 44% is the tax rate. Okay, so tax rate we need to compute. Now present debt is 1000 crores is the present debt. It is already given in the question. Okay, now interest cost in terms of percentage, we know the numbers. We don't know the exact percentage, but we know the numbers. So 106.25 divided by 1000, that is the interest rate. 106.25 divided by 1000. So the tax rate, the interest rate is 10.63. So 106.25 divided by 1000 multiplied by 100 is the interest rate. So interest rate is 10.63. Equity capital 3235, that is the equity capital, and this is the debt 1000. Now what are the weights? We have taken the weights, we have taken the cost, and weighted average cost of capital is also taken by us. Now you know the cost of debt is 10.63%. Now I have not reduced tax in it. This is pre-tax. So post-tax is 4.99. How 4.99 is 5.99? How is 5.99 computed? So 10.625 multiplied by or minus 44%. We'll get this amount. Okay, so this minus the tax rate. To be accurate, 44 is not 44. 43.6 is the tax rate actually. Then you'll get 5.99. Now I'm getting a little bit of variation, which is okay, which is not a problem. So this is post-tax. This is post-tax, and this is pre-tax. That's why the difference. Okay, pre-tax and post-tax. That is why the difference. And guys, cost of equity is also already given in the question. Cost of equity is already given in the question. We have computed the weighted average cost of capital. Now, weighted average cost of capital beyond 2005 is to be recomputed because debt has reduced by 30%. Debt has reduced by 30%. 700 is the debt. Equity remains the same. Again, we'll calculate the WACC using the revised weights of debt and equity. And now we are going to calculate our computation in two parts: pre 2005 and post 2005. That's the computation which we need to do. Pre 2005 and post 2005, and the weighted average cost of capital is also to be different. Pre 10.75, post 11.53, which means while calculating the terminal value, we are going to use WACC as 11.53. While calculating the initial period 1 to 5 cash flow, we are going to use the rate as 10.75. That's the difference that we are going to calculate. Okay, sir, got it. So this is the present value of free cash flow 10.75. Terminal value is also calculated using this method, and this is a straightforward computation, guys. Nothing complicated in this particular calculation. It was only the the calculation of the tax rates which was critical in this case, and the bifurcation. Bifurcation is important post 2005 and pre 2005. That is how the computation is required to be done in this case. Terminal values calculated in a straightforward manner. Nothing complicated about it. Okay, sir, got it. So this is the value per share, which is the value of the firm divided by number of shares. Okay. Yes, no other complicated point that I have written in my notebook. A straightforward question. And guys, please, just scanning through these questions are not enough. You need to actually practice them in the register yourself. It's really important. So after watching this video completely, please pick up the PDF, get it printed. It's available on the institute website. I've also saved it in the system. Also, I've saved it. Please take this PDF. Do not see the answers. Just compute your answers yourself. Try it out yourself. Okay. Okay. Illustration number 2. A very easy and a straightforward question. Okay. A straightforward question. Nothing to be discussed in it. The cost of merger is required to be calculated. Present value of A, present value of B plus benefit. This is the present value of the combined company. Compensation minus present value of B is required to be calculated. Then what is the NPV to Jaiswal? Jaiswal NPV is the benefit which is accruing to Jaiswal. Okay, then NPV of Agrawal is the price that he is paying and the benefit that he is reaping. That is the benefit of NPV of Agrawal. So NPV of Agrawal and NPV of Jaiswal is required to be calculated. A very simple question, a straightforward question of merger and acquisition. A very standard question, guys. We've done such questions, many such questions in the class. Illustration number 3, again, very simple, straightforward. Illustration number 3, cost of merger is required to be calculated, guys. We have studied this share of Evening Limited in combined firm, how to calculate in the combined firm. Then the cost of merger, very popular phenomena. Cost of merger is required to be calculated in these questions. Okay, cost of merger. NPV to the acquirer company, benefit minus cost. This is the NPV which is there to the acquirer company, and this is the NPV to the acquired company. Okay, a very simple and straightforward question. Yes, this question is interesting. Yes, I need to discuss this. All right, let's discuss illustration number 4. Merger proposal of PJ and PD Limited is under consideration. You are required to compute NPV to PD. What is the NPV which is given to PD? Using the capital budgeting technique, the following information is provided. Equity related post-tax cash flows are given to you. So these are the post-tax cash flows which are given to you of PJ. These are of the PJ. And if both of them merge together, then these are the cash flows of the combined entity. These are the cash flows of the combined entity. Cash flows beyond 5 years are expected to grow at a compound rate of 6%, which means terminal value is expected to grow at a constant rate of 6%. The number of outstanding shares of PJ prior to the merger is 12 lakhs. So prior to the merger, the outstanding shares were 12 lakhs. The number of outstanding shares of PD is 7 lakhs prior to merger. Proposed exchange ratio is 3.3. Okay. Assume a discount rate of 13.5%. In both the cases, the discount rate is 13.5%. So let's do the computation now. So first I'm going to take the cash flow before the merger. Cash flow before the merger, present value is required to be calculated. So before merger, present value of cash flow is 721.41. The terminal value is also computed in this question, guys. And present value of cash flow after the merger. After the merger, the present value of cash flow is 1088. Again, we are calculating the terminal value also in this particular question. So we are taking both of them. So this is the sum of present value of cash flow after merger, and this is the sum of present value of cash flow before the merger. So this is the additional benefit that we are going to accrue. Now, what is the position of shareholders of PJ Limited in the combined firm? After the merger takes place, how much is the the value of PJ Limited in the combined firm, it is 85% of the total company. 85% of the total company. And what is the value of the company before merger? Value of the company before merger was 111.35. So this is the NPV of PJ Limited. We need to calculate the NPV of PJ Limited. This is the net present value which will accrue to the PJ Limited. What is it going to get after merger? Okay, and what is it which it will be losing? Okay, so 85% is going to get in the entire firm. It will be losing out on the value of the the target company. 111.35 it will be losing. So this is the NPV which is calculated. Okay, so yes, little bit difficult calculation, but the concept remains the same. Okay, so got it. Illustration number 5 is again a easy and a straightforward one, not to be discussed. Similar question done in class, purchase price premium question, very average standard question that we have done in class. Please do this question also, a very straightforward question. Okay, so got it. Illustration number 6. Yes, this we need to discuss a little bit. However, this is little easy, not very difficult, but it is all calculation based. Okay, it is calculation based, but let's discuss it a little bit. All right. So this is Apollo Textile Manufacturing Company based in West Bengal, has aggressive plans for expanding. The company is planning to set up manufacturing based in Odisha to cater to customers based in North India to get faster market access. Company has decided in favor of an acquisition. So Apollo is acquiring Ganesh. Company has undertaken a detailed study of prospective buyers and the company which fits in best with the strategic goal. After having collected relevant information, company is now faced with the case of arriving at reasonably correct value of Ganesh. The company has to calculate the value of Ganesh in order to begin takeover negotiation. The company balance sheet is given to you. Additional information is also given. Use the discounted cash flow approach to value the company. You have to calculate the discounted cash flow way. Balance sheet is given to you. Capital expenditure will be 3 crore incurred in 2012, 11 crore in 2013. The net sales, the cash flow details are also given to you. These are the cash flow details. Beta, RF, RM. So CAPM method will be used to calculate the cost of equity. Current market price is given to you. Tax rate is given to you. Bank finance. So this is the cost of debt. Okay, cost of debt is given to you. Additional capital is required, 12 crores and 10 crores. Additional capital is also required. Okay, got it. All right. So first of all, we'll calculate the cost of capital. Number of equity shares, market value of equity, one equity share. This is the market value of debt. So market value of debt is taken, market value of equity is taken. So both of them total is 66 crores. So we need to calculate the cost of capital using the weighted average cost of capital method. Okay. And the debt is 15 and 51 is the ratio. So these are the weights and these are the cost. 12.96% and cost of equity is 15%. So cost of debt is already given as 18%. We are going to reduce tax from this cost of debt to get our value of the cost of debt post tax. Okay, cost of debt pre tax is 18%. 18% minus what is the tax rate? Tax rate is 28%. So 18% minus 28% gives me a cost of debt of 12.96%. So this is 18 minus 28%. Okay, and this cost of equity is calculated using the CAPM model, guys. Okay, CAPM model. So CAPM model is 12. 1.12 is the beta multiplied by 3% plus 12. Okay, so guys, this is not 15. This is 15.36%. So while averaging out, while removing the decimals, we have taken as 15. It is not 15. 15.36 using the CAPM model, risk free plus beta multiplied by the risk premium. Okay, so that is how 14.81 is computed. So weighted average cost of capital is computed by us. Then we will calculate the cash flows. So these are the cash flows. Pretty straightforward computation, guys. Nothing to be really discussed, and you get the sum of present value of cash flows. Okay, cash flows are pretty straightforward. Yes, nothing very technical in these cash flows. You have to remember that additional capital is involved, 15, additional capital is 12, and term loan which is additional is 10, that you need to take care of. All right. Alright, rest entire calculation is absolutely straightforward. Okay, so that is how the answer is required to be calculated. Value of the company is also given to you. Okay, sir, got it. Illustration number 7. Yes, an important, a good question. Indeed, a good question. The shares of Amrit Corporate Limited are currently being traded for 27 per share. So the market price of the share is 27 per share. The top management together with their families control 36% of 12 lakh shares. Okay, so the controlling interest is 36 lakh out of 12 lakh shares. 36% out of 12 lakh shares. Piyush wishes to acquire ACL because of likely synergies. The estimated present value of these synergies is 76 lakhs. So synergy value is 76 lakhs. Moreover, PCL feels that management of ACL is overpaid. So by reducing the salary, there will be an additional value which is driven, which is 26.5 lakh. Salary will be reduced by 3.7 lakh and additional value that will be added is 26.5 lakhs in the acquisition. Earning per share is given to you, number of outstanding shares, and market price per share is given to you of PCL company. What is the maximum price per share that PCL can offer to pay for ACL? Maximum price means entire synergy benefit is transferred to the shareholders of ACL. What is the minimum price per share at which management of ACL will be willing to give up their controlling interest? It is the reduction in the salary, which is the additional value that is derived out of that, plus their equity value. That's it. They will forego, because it is a minimum price, they will forego the additional synergy, but they will take the synergy which is owing to their salaries. Please note that. So minimum, maximum price, minimum price. So please take note of these words, very, very important. Calculate share exchange ratio, acquisition premium, these are very simple. Okay, now present value of the companies is 324, synergy gains, savings due to salaries, total value is 426,500. So maximum share price that we are going to offer is their shares, 12 lakh shares, shareholders, and this is the value. Okay, so company's value plus the synergies, we are going to transfer it all to them. Maximum value that we are going to offer is rupees 35.54 per share. The minimum value that they are going to charge, ACL is going to take, is their its own share value, 36%, which is the controlling interest, right? Plus the synergy of salaries only. So this synergy at least they will take because it is owing to them. This salary, this synergy they may forego because you have to calculate the minimum price. Okay, so minimum price is 143.14 thousand, and the minimum share price is this that they are going to take for sure. Then price offered to Amrit is 34. Okay, now in part 3, calculate the share exchange ratio. You add on one thing, assuming that the price offered is rupees 34 per share, because this information is required to be given in the question to solve this question. Calculate the share exchange ratio. 34 is the value of the price which is offered to Amrit Limited shareholders, then 34 divided by 36.94 multiplied by 12 lakh is the share exchange ratio. The acquisition premium is 34 minus 27. In percentage terms, it's 26%. If we directly do it 34 by 27, that will be in the times term. Okay, so this is the price which is offered. Okay, so got it. So this was illustration number 7. Interesting question, a question which will have your calculation very strong over this particular concept. Okay, all right. So guys, illustration number 8. Now the point is this: illustration number 8 refers to the two level. Yes, this is the two-level growth model, two-phase growth model. And I always say that this is just a formula-based model, two-level growth model. If you are unable to remember the formula also, then you can leave this concept altogether. Don't do this concept even if it comes in the examination for say 4 marks, 5 marks, 6 marks. Just assume that you have to do paper for 96 marks only or 94 marks only. Because this formula is complicated, its application is complicated, and to mug up this formula and then reproduce in the examination, I don't think it's worth the time that we spend in it. However, I've discussed it in the class briefly, and I've done questions also in the class, but I would suggest you to leave this question. If you have not done in past, then leave this question, illustration number 8, you can leave or just mug up the formula as I've done in the class and just do in the question, because it's not worth getting into the formula, understanding it in depth, and then appearing for only 4 marks and 5 marks in the examinations. that's my strategy for illustration number 8. Then after that, illustration number 9, the comparables company approach, relative valuation method, absolutely straightforward question, very, very simple question. You have to compute the average comparables and multiply it by the company's financials to get your answer. Illustration number 10, again, a straightforward question, very straightforward question, cost of merger, gain from merger is required to be calculated, absolutely straightforward. 11 question, 12 question, okay, 13th question. These are all the questions that I've done in the class, and most of them are absolutely straightforward, and absolutely no comments that I've written in these questions in doing these questions, because they are very, very straightforward and they are absolutely easy in terms of your understanding. So yes guys, by this I cover my entire coverage of workbook in a brief manner. My endeavor was to pick up the obstacles which you could find in your way of doing the workbook. Rest, if you still face any problem in rest of the questions, because doing all the questions would mean that, you know, we'll employ 10 to 15 hours to do all the questions, which is not worth it, because now is the time for self-study. You should do those, the question that I'm telling you, you know, they are easy. You should be able to do it them yourselves, guys, because they are very straightforward and we have discussed the concept in the class. So you should be able to clearly do them yourself. That is the basic, you know, fundamental behind these questions. Okay. All right, guys. Yes, that's all for this particular session. And please do this workbook carefully. Please do this workbook religiously, because even if one question comes from this workbook, it will all be worth it, because it will be a lengthy question, it will be a tough question. So it will all be worth it. So do this workbook. And yes, exam is round the corner. Please comment in the comment section below if you really like discussion of this workbook and what do you want to achieve in your final outcome. Is it CMA? If yes, then comment in the comment section below. I want to be CMA in the upcoming attempt. On that positive note, all the very best and happy studying. Bye bye. See you in the next session.